Good morning and welcome to The Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Monday, July 13th, and we have a lot to work through. Iran tensions are rattling markets, semiconductors are taking a real hit, and bank earnings kick off tomorrow. Let's get straight into it. Lizzie, big picture, Iran tensions, a semiconductor sell-off, bank earnings tomorrow. What's the dominant theme driving your trading decisions this morning?
Morning, Robert. The dominant theme is geopolitical risk colliding with valuation fatigue at exactly the wrong moment. Trump's announcement, reinstating an Iranian blockade and slapping a 20% toll on Strait of Hormuz cargo, sent crude spiking and dragged the Dow, S&P and Nasdaq lower. And that's landing right as investors were already questioning whether big tech's AI spending can sustain these elevated multiples. The setup is genuinely uncomfortable. You've got energy as the lone sector catching a bid, while everything else faces pressure heading into what should be a high-stakes earnings week.
SanDisk dropped 13% today, even after Evercore more than doubled its price target to 300. How do you trade that?
That price action is a classic signal that the market isn't ready to trust the analyst upgrade right now. SanDisk is still up over 600% on the year, so what you're seeing is profit-taking from traders who were already sitting on enormous gains and needed a catalyst, or really any excuse, to reduce exposure. And the geopolitical backdrop gave them exactly that cover. Until the broader semiconductor selling pressure exhausts itself, you're not stepping in front of that freight train, regardless of what any price target says.
The semiconductor index is down nearly 5%, while software stocks are actually bouncing. Is this a genuine rotation within the AI trade, or just profit-taking in the names that ran hardest?
It looks like a rotation more than a wholesale exit, and the iShares expanded tech software ETF gaining 0.8%, while the PHLX semiconductor index falls 4.6%. In the same session tells that story pretty clearly. Money appears to be moving from the hardware and chip names, Nvidia, Micron, SK Hynix, towards software plays where the AI spending narrative still holds, but the valuations didn't run as aggressively. That said, you want to watch whether this rotation has legs or whether it's just a one-day repositioning trade ahead of earnings.
AppLovin is heading for its fifth straight losing session on slowing e-commerce ad data. Is there a trade here?
5 consecutive sessions of losses with deteriorating data signals is not a setup where you want to be a hero. The e-commerce advertising slowdown is a fundamental concern rather than a sentiment-driven dip. So until you see either a stabilization in that data or a capitulation volume spike that suggests sellers are exhausted, the cleaner move is to wait on the sidelines and let the structure rebuild before considering any entry.
Steve, CPI drops tomorrow and PPI comes the day after. How significant is this inflation data given energy prices are already moving on the Hormuz situation?
This week's inflation data is about as significant as it gets right now, Robert. The June CPI prints tomorrow, July 14th, with the previous May reading sitting at an index level of 335.12, which came in essentially in line with the 303.11 forecast, so the baseline is relatively contained. The complication is that the Hormuz situation is pushing crude higher today, and while one day of energy price movement won't show up in the June numbers, it absolutely frames the narrative around whether July CPI could start moving in an unwelcome direction, which makes tomorrow's print a critical baseline reference point.
June NFP came in at just 57,000 jobs against a forecast of 110,000. That's a significant miss. Does that change the Fed's calculus heading into July 29th?
A 57,000 print against a 110,000 forecast is a meaningful deterioration, and it follows an already softening trend from the prior 129,000 reading. So the labor market is clearly losing momentum. The Fed held at 3.7% at the June 17th meeting, and the July 29th decision is the next live event on the calendar. What makes this particularly tricky is that weak jobs data would normally argue for cuts, but if the CPI data tomorrow or PPI on Wednesday show energy-driven inflation pressures building, the Fed is caught between two competing signals, and the most likely outcome is that they stay on hold and wait for more clarity.
Is there any realistic scenario where the Fed moves before July 29th?
An intermeeting move is extraordinarily rare and essentially requires a systemic financial crisis rather than softening economic data. So no, realistically, the Fed is firmly on hold until July 29th, regardless of what the jobs numbers or energy prices do between now and then. What the weak NFP and the Hormuz situation do is increase the probability that the Fed's accompanying statement on the 29th takes on a more cautious tone, and markets will be scrutinizing every word of that communication for hints about the September meeting and beyond.
Retail sales for June comes out Thursday alongside jobless claims. After that strong 0.9% May print, what are you watching for?
The May retail sales number was genuinely solid, coming in at 0.9% against a 0.5% forecast and well above the prior 0%, which suggested the consumer was holding up despite broader uncertainty. For the June print on Thursday, the concern is that the weak NFP data from earlier this month could signal that consumer spending is starting to crack, and a significantly softer number would compound the labor market worry into a more coherent narrative about slowing growth. Jobless claims on the same day will matter too. The prior week's forecast was around 219,000, and any meaningful move above that range alongside soft retail sales would put real pressure on risk assets heading into the back half of the week.
Q1 GDP came in at 2.1%, well above the 1.6% forecast. But with NFP cratering and durable goods down 4% in May, are we heading into a stagflation setup ahead of the Q2 GDP print on July 30th?
The Q1 GDP beat was genuinely encouraging. 2.1% actual against a 1.6% forecast and recovering from a very weak 0.5% prior reading. But the subsequent data points have not been supportive of that momentum carrying into Q2. Durable goods falling 4.9% in May, NFP missing badly in June, and now energy prices moving higher on geopolitical risk creates a combination that markets will rightly start describing as stagflationary in character. The Q2 GDP advance estimate drops on July 30th, and given the data flow, the risk is clearly to the downside relative to the Q1 print.
Lizzie, earnings season kicks off tomorrow with the major banks. Goldman, Morgan Stanley, Citi and BOFM are all expected to post 27 to nearly 39% EPS growth. Is that already priced in?
The KBE Bank ETF is already up 12.4% year to date, outpacing the S&P 500, which tells you a meaningful amount of optimism is already embedded in these prices. That said, the trading revenue tailwind from a volatile quarter and the capital markets revival could produce genuine beats that surprise even elevated expectations, particularly for Goldman and Morgan Stanley, where trading desks have had exceptional conditions to work with. The real risk is that results land in line rather than materially above consensus, which in this environment of geopolitical uncertainty could be enough for traders to sell the news.
Energy is the one bright spot today with crude spiking on Hormuz news. Names like Chevron and Targa Resources catching bids. Is this a trade you're chasing?
The energy sector has already outperformed the S&P 500 by 8.5 percentage points over the past 6 months, so you're not finding an undiscovered trade here. Chasing a geopolitical spike in crude is a high-risk move because these situations can de-escalate as quickly as they escalate. And if a diplomatic resolution, or even just cooler rhetoric emerges, that energy bid reverses hard and fast. Targa reaching a new high and approaching a potential buy point is more technically interesting than a straight Chevron momentum trade, but the geopolitical premium makes sizing discipline absolutely critical here.
Let's move to crypto. Bitcoin is hovering around 62,000. Over $200 million in longs got liquidated, and spot volume is contracting. Is this a dip to buy or a reason to stay on the sidelines?
The structure here is cautionary rather than opportunistic. When the 14-day RSI pushed towards 67, near overbought territory, while spot volume simultaneously contracted 21.5%, and the cumulative volume delta flipped negative, that combination tells you the recent rally lacked genuine conviction behind it. Over $200 million in leveraged long liquidations is a meaningful flush, but the question is whether that's sufficient to reset the market or just the beginning of a larger deleveraging event. And with the geopolitical backdrop still unresolved, the risk-reward for new long positions at 62,000 is not compelling right now.
Ethereum is down 64% from its 25 peak, but the tokenized real-world asset narrative keeps building. Does that give you any conviction to add here?
The fundamental case for Ethereum is genuinely substantive. Hosting nearly half of all real-world assets by value at around $16 billion and $152 billion in stablecoins is a real structural position in the financial system, and McKinsey's estimate of a $4 trillion tokenization market by 2030 is a significant long-term addressable opportunity. But at $1,779 with price action under consistent pressure and broader crypto sentiment in fear territory, the fundamental narrative and the current market structure are pointing in opposite directions. And in that situation, the price action tends to win the near-term argument, while fundamentals matter for longer time horizons.
Palo Alto Networks is up 95% in 3 months and now sits at a 10% weighting inside IGV. Is that concentration risk a warning sign for the broader tech rally?
A single stock sitting at 10.3% of a fund that investors believe is diversified, trading 59% above its 200-day moving average at a forward PE of roughly 86 times, is a genuinely notable risk that most holders probably aren't fully aware of. If PNW reverts even to its 200-day moving average, a decline of around 37%, that alone shaves 3.8% off IGV's total value. and the ETF structure means you can't surgically remove just that exposure without potentially triggering capital gains on the entire position. It's a meaningful consideration for anyone holding broad software ETFs as what they think is a diversified tech position.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. We'll see you tomorrow.